Hey everyone, just wanted to talk a little bit about the week that was and the week that is coming up. Last week definitely was not a dull week, lots of stuff happening out there. Of course, last week was the data point that everybody's been looking for, that NFP non-farm payroll number, as the market, as Powell has shifted from being focused on inflation, which is generally considered to be conquered at this point, to labor. Every data point is becoming the one to watch. And so I think we're going to just kind of, jump like Frogger, jump from spot to spot, waiting for that next data point. And in between, we might just have a little bit of nothing going on. And that might keep a little bit of a floor in the VIX for some time to come. Of course, the week before was NVIDIA. That was the earnings report. And really, they were expecting about 11 or 12%, but really not a whole lot happening there. Although we stayed negative on it. We've been negative on Microsoft, NVIDIA, and AI in general. We've been adding NVIDIA puts, making really, really good money on them in the community, in the Discord, which you get with the program. And so today we're going to talk a little bit about all the data now, because it is all about data. Let's focus on the data. Let's not get distracted too much by the noise, by the rhetoric, by the false narratives. Let's really take a close look of what's happening out there. We'll look at last week's performance, some charts. We'll look at the economy. Does the economy look like it warrants 50% rate cut? Does 50 basis point rate cut? Is that warranted? I don't know. Flows and volatility. We'll finish off there with a little bit deeper stuff. So let's look at what happened. Friday, we had that August non-farm payroll number, 142,000 versus consensus of 165. So not a great number, but generally speaking, not a bad number at all. This is not bad for the economy. Compared to a couple of years ago in the pandemic, sure, it's not as good. We had those incredible hiring years. So we've definitely softened a little bit, but if we keep it in perspective, really not that bad. Now, what may have gotten people a little bit excited to the negative was we saw a revision on the previous number to 89,000 from 114,000. So there may be some worry that numbers are going to be revised from here on in. So there's going to be some uncertainty in the actual data that's being presented, which is never very reliable, and what eventually gets revised. Private payrolls also down a little bit, 118 versus 142 consensus, so a little negative there. On the positive side, unemployment rate of 4.2%, so that's down from 4.3%. And so I've been talking about for at least a month that I just thought the unemployment number was nonsense. It had more to do with immigration, with supply, maybe a little bit of seasonal. And sure enough, maybe this proves that was the case. So all around, the report wasn't great. It wasn't terrible. Maybe not quite as good as the highest whisper numbers. And it wasn't, but overall the market just didn't like it. But it's certainly not too strong a sign of a pending recession, that's for sure. As we're going to see in data later on, Challenger firings pointing down. Now, the market started to sell off. Waller said he's open to front loading. He's a voting member of the FOMC, open to front loading, which means bringing some of those rate cuts forward. So he's open to larger rate cuts is basically what he's saying. So that in itself is a little bit of a concern. When somebody says 50 basis points, that becomes a little bit more of a concern, right? Because it sounds a little bit panicky. And that's part of the reason I think they're not going to do 50, because that is panicky and it's utterly unwarranted, I would say. So let's take a look at what we saw last week. Terrible day on Friday, but the week was really, really something terrible. Dow down 3% as expected, not as bad. S&P down 4.25%, NASDAQ down 5.77%, really, really ugly. Russell 2000, curiously, quite a bit down as well. Now, we'll talk about why that is a little bit later. As we look into the sectors, Transports, banks, got crushed. Oil services getting crushed on the possibility that a weakening global economy is going to require less oil. Technology down a whole whack again. And semiconductors just getting taken out to the shed. Really, really ugly there. Consumer staples up. Utilities, real estate hanging in there. Throw in gold, and really you've got kind of that good basket of safe haven type areas that have been working. Let's look at Bitcoin. Not pretty at all. Inflation down, if growth comes down. Bitcoin is also kind of, it attracts speculative money, and this market is, as you can see, speculative money is getting hurt. The lower quality tech names, for example, doing very, very terribly. Speculation is unwinding, right? So it's coming out of the economy, which is part of what Powell wanted. He wanted some of that fluff to come out from those heady kind of 2021 days where Rolex prices were going up, 5% a week kind of thing. So it was, these were the days. So we'll see if Bitcoin can hold some of these levels. A little bit worried there. Ethereum really pulling back as well. Not a great sign, as that has a little bit more utility. Commodities, weak. Generally, natural gas hanging in there, corn, wheat, coffee, okay. But generally, you'd expect commodities not to do that great in a global recession, which again, I think is really, really overdone. And bonds doing very, very well as yields pull back into those expectations of more rate cuts. So let's take a look at the S&P weekly. So coming down to that 20-week moving average, which was respected back in April, bounced off there to make new highs. We breached it in early August, of course, with that volatility type flash crash, bounce back up. So a little bit of a chance we kind of get down. I think we closed just a little bit above that 20-week. Chance we can get down there, which is supported by this chart here. We can see that we've now unraveled a good portion of this rally from the bottom here in early August to the top more recently in late August. We've pulled back almost to that 50% fib retracement line. So that might be a good spot for you to consider covering shorts, maybe adding some small longs at that point. As we'll talk about soon, still a little worried about this market. So not a big fan. All of our risk gauges in our community are pointing to continued volatility and difficulty in these markets. So I would say that we are nowhere near out of the woods. But if you do want to start picking some spots, the fib retracement, and then certainly back to this trend line, we can see when the market blasted and gapped through that trend line there, that was a sign that a continuation could come, and we consolidated during the sort of envelope. The breakdown through there was really very, very telling on Tuesday. Very unexpected. I was quite bullish up here, so I'm going to be the first to admit this was a big reversal of what looked like was going to be new highs. A lot of flows, CTA buying, vol targeting, things like that being very, very supportive. Corporate buybacks being very, very supportive until sort of mid-September, and they just pulled the rug out. And so this was really somewhat unexpected. As we'll see perhaps in some of the volatility measures here in a moment. Let's take a look at the NASDAQ. QQQs pulling back as well. Look at that much, much lower high that they made as opposed to the SPX, which really made almost a perfect double top there. So NASDAQ really being the driver of the economy and of the stock market for a long, long time. Of course, it's the one to watch. We've pulled back to this kind of neckline here, the scene of this particular breakout. But really, realistically, I think if we don't hold here, then I think you've got to be considering this long weekly trend line that we have drawn out here as being support probably around the 430, 433 line by the time we get there a couple of days later, maybe 435. So, and again, I'm not a huge fan of the Microsofts and NVIDIAs. I haven't been for a while. And so I think there's more downside potentially to come in those areas. Now, this is one of the reasons I'm still a little bit cautious, is that we have seen some dislocation in volatility markets. So if we look at the VIX here, we had this extreme outsized move up to 65, which we've talked about ad nauseum. But the important thing here is that we've actually gotten a second dislocation of sorts. Look at the VVIX. The VVIX is in the next chart here. The VVIX is the volatility of volatility. And look at the run that it had on Tuesday. That was an unbelievably strong run. Very, very indicative of dealers having a tough time handling hedging these positions that they've been selling. So these upside VIX structures, the protection that people are buying, the street is having some trouble in reconciling how to hedge those things out. And so that to me is somewhat of a concern. It's a little bit of a sign of a lot of people trying to get through a small exit door at times. And so these two events put together lead me to believe that there's something a little bit offside. Now, maybe not quite broken, but definitely a little bit offside from a structural standpoint. We're going to talk about the economy in a moment, but from a market flows and structure standpoint, there are some strange things happening. So I think those need to be respected. Russell 2000, the IWM here, very interesting thing to watch. It's been extremely volatile for a few months now, and really that's because I think we're trying to find some evidence that there actually is a broadening out of the economy potentially happening here. And so I think it's still sitting okay. It's pulled back a little bit because, of course, in a terrible market, a lot of things are going to correlate to one. So they're going to just sell everything. It's a liquidity event. They sell gold. They sell stocks of most kinds in order to raise money. So sometimes you can't read into those kinds of severe down days too much, because that's just what happens in markets, is everybody sells everything they can to raise money in other places. So we get this big sell-off here. And so the whole narrative is really one of, listen, are we going to get rate cuts into a slowing but okay economy? Is the porridge going to remain warm, or are we going to head towards something more of a harder landing type scenario, which won't be as good for the broader economy? Yes, the broader economy is going to benefit from lower interest rates, but the stock market really has a very different trajectory when it comes to recession versus very sort of soft landing, kind of a more managed rate cut cycle, right? Very different scenarios between good economy and a reasonable economy and recession in terms of how the stock market accepts that. So right now the Russell is really struggling with that narrative. Is this going to be rates coming down because they're just too high, because real rates are too high? Or is it going to be coming down because there's a real softening in the economy? So these are things that need to be resolved over the next few months. And that's, again, why we say data is extremely important here. Again, the RSP is something I like to look at. That's the equal weight S&P 500 versus the market cap weight. Market cap weight is going to have that high concentration in, say, 30 to 40% of the names in the index. Very heavily weighted names, generally in the tech area. RSP is more of an equal weight. So basically, an Apple has the same weight as a tiny company, a small company in the S&P 500. So it is something that tends to do well in terms of broadening out in the market. So you're going to see RSP outperform the S&P like it did here. This is an outperformance of the RSP versus the SPY. And that's the rest of the economy. So think of the other 493, right? Forget the Mag 7. Think of the other 493 doing well. That's what this is depicting. Here it pulls back a little bit, but again, we get that outperformance, that broadening of the stock market. Here again, because of that correlation in a very bad day, we saw outperformance of the broad market, and then it pulled back because in a severe sell-off, everything gets sold off. So interesting times. We're going to have to see how some of these things resolve. What have we got this week? We've got two inflation reports: August consumer prices, CPI, August producer prices. PPI really not that important, but CPI very, very important. So high importance. We see initial claims and continuing claims as well, very, very important. So we're going to be watching these things. We can see claims down here coming down, so really not bad at all. But again, data-driven type market at this point. So we're going to see VIX levels kind of hang in there, maybe at the sort of minimum 19 to 20 level, as we sort of head into that difficult end of September seasonal, early October seasonal period, which is difficult for markets, as well as all this data and all this uncertainty surrounding where rates are going, where the economy is going, et cetera, et cetera. A lot of things up in the air. As we can see, the market is about 67% in expecting a 25 basis point cut, 33% expecting a 50 basis point cut. I think that's very, very wrong, but we'll see how that looks. A month ago, when we had that original kind of flash vol crash, we were about 50-50. In fact, the market was favoring a 50 basis point cut at that point. So not so much now as we get near this current FOMC market, looking for really 25 basis points at this point. Not many companies in the S&P 500 reporting, although Oracle and Adobe tend to be a little bit important on the tech side. And as we talked about, tech is very, very important right now. It's really kind of driving markets overall in terms of withdrawing some of that sort of positive expectation that we got from this big AI push. Right, that big AI push that's going to lift everything and lift the whole world. Well, we've seen that unravel. So tech is important from that perspective, even though I see a much bigger broadening out happening. So let's talk about some of the data here. Change in employment, really household survey, establishment survey, looking great. Let's look at some of the consumer spending here. Debit card transactions, fantastic. Little turn down right at the end here, but very, very positive. Look at this across sectors, unbelievable. People buying sporting goods, instruments, books, clothing. They're getting out there. They're enjoying life. They're spending money. No sign of a real slowdown here. Look at this: credit card transactions, food services, general merchandise, health, personal. I mean, look at this spending. It's unbelievable. So very positive sign there for the economy. Weekly data, same-store retail sales, fantastic. Initial jobless claims heading down. Weekly bankruptcy filings, absolutely nothing to worry about there, pointing down. GDP looking just fine, over 2% from the Atlanta Fed number. Atlanta Now number. Record low levels of layoffs. Look at that, nothing to worry about. And then last but not least, record S&P profit margins. I mean, these companies are doing fantastic. So, I mean, do margins come under pressure a little bit as inflation comes down, as that pricing power comes down for companies that really jacked up prices and probably shouldn't have? Maybe there's a little bit of that. But at the moment, things looking very, very good. Now, what worries me? Well, a month ago, we talked about these gamma flows. Now, I don't want to get into things that are too deep in the weeds here, but just know that gamma flows, you're going to be hearing much more about that, because flows are really a big part of what make markets move at this point. And I think you kind of have to know about it a little bit. These CTA strategies, these vol targeting strategies, risk parity, etc., momentum strategies. These are strategies that have a big impact. The growth in inverse products, all these ETPs out there that are attracting money in the vol space or otherwise, triple products, double products. All these things have an effect on markets, and so you need to know some of these things. And gamma flows basically that tell you, look, are dealers short gamma or are they long gamma? When they're short gamma, as in down here, they tend to push things down. So these products and dealers, they're selling stocks into sell-offs and they're buying stocks into rallies. That pushes volatility higher. In a positive gamma environment, you get dealers selling into rallies and buying into sell-offs. This is, if you want to know a little bit more about this, I've posted in the description below a video that I did on gamma squeezes. I was a professional option market maker for about 12 years, and these are the things that I did. So if you want to know about this, you can hear about it from the horse's mouth. There's a little bit more to it once you get into Vanna and Charm and some of these next level derivative Greeks. And I'm going to get into that at some point in the video, but in a very easy to understand way, I go about how dealers deal with things that ultimately you want to know about for things like GME, gamma squeezes. Why are stocks pinning at certain strikes for options, or why are stocks flying through strikes on a stock like GME when it goes from 20 to 50 bucks? Like, why are these things happening? So take a look at that video there. My concern is this was a month ago, and I said, look, if we get back up into 5350, 5400, we're going to have a melt up, which is exactly what happened. If we look at today's picture, we've now moved down into this very thin positive gamma area. So my worry is that we get back down into this world here, which is negative gamma. This is where you start to see a heightened volatility from these flows that we're talking about. And again, this is a world where you have to almost think of it as vol begets vol. Higher vol means even higher vol, and low vol means even lower vol. This is something that I would almost refer to as a kind of vol clustering effect, right? So when volatility is low, it wants to stay low for a long time. It always has for decades and decades, but it's even more so that is really a sort of feature of markets these days. And then when things break the other way, all heck breaks loose. And there are reasons for that. This is a new world, right? I've written down here a new world where many of these types of strategies have this big effect on flows. All these products that I talked about are going to push things around. So as we can see, versus 10 days ago, which was an environment where CTAs and vol targeting were buying the market as it went higher, or as it even sat still, right? So vol targeting is going to buy the market as it sits still because volatility comes down, and that means it buys more. When it buys more, volatility comes down even more because it's supportive of the market. And when volatility comes down, that means it buys more. So you can see there's sort of this positive feedback loop. Well, it works the other way too. When there's heightened volatility, these funds have to now start to sell stocks. That increases volatility, that contributes to more volatility at the very least, and meaning they have to sell more stocks. So you can kind of see how things get pushed in one direction or another. The problem right now is on a small downward move in markets, we do get more selling from these funds. On a larger move, we get even more selling, and on a very strong downward move, we actually get extremely high levels of selling. So it's almost like if we get down a couple hundred points of the S&P, you could even argue for things going down 300, 400, 500 points. And I don't see that happening, but I'm just saying you need to be very careful. Now, our indicators in our community, which I post every single day, have been off for a long time now, right? They've been risk off. And these are the kinds of things you need. If you are an option seller, if you are a trader, you need to know about these kinds of things. And that's what we're all about in all of my programs. We're all about smart, thoughtful, risk-managed option selling. Because if you're not looking at things from a risk perspective, you're just not going to make it in this game. So that's where it's at. And on that note, please check out my 4-day free options trading challenge, crushthepremium.com/4-day challenge. Check it out. You get 4 days of really amazing strategies and I really packed a lot of value into this free course. And at the end of it, you'll be offered a chance to get into the full program, which includes, Discord community. It includes all kinds of great stuff, more education, me hand-holding, helping you out with the various pillars that we teach in the program, right? Where to buy the stock, how to find quality stocks, how to react to sell-offs, how to react to high conviction, low conviction, medium conviction setups. There's a different way of approaching different things because you need to put yourself in a position where you're trading the edge. And if there's no edge there, you don't do it. Simple as that. I have no problem sitting on my hands for a week, and good traders are like that. So you have to kind of exercise those muscles and get better at that stuff. And in the program, that's exactly what we teach people. So thanks for watching, and good luck this week. I'll be putting a couple videos out on some other things, and I'm going to be trying to set up that live session so that we can go over gamma trading versus positions in the aftermarket, so that you guys understand a little bit of how to turn call positions into put positions back and forth in order to trade the swings back and forth. So I'm going to try to set that up very soon, and we'll see you guys soon. Thanks for watching.